So when you're ready to move forward with your goals, let's look at what are my goals. Do you have that liquid money sitting there in a pinch so that you're not borrowing or liquidating those assets when preserving your assets was so important to you? You put 4% of your income in and we'll put in 2% or 4%. We'll match. That's free money. Forget the stock markets. That's that's a 50 to 100% return right there.
Divorce can be emotionally and financially overwhelming. That's why I'm teaming up with Sunny Wishart, president and founder of A La Carte Financial and a certified financial planner. We will show you how to understand all things money without feeling ashamed, overwhelmed, embarrassed. You will learn more, ask questions. No question is a dumb question. Welcome to Money with Sunny. Let's get into it.
Good morning, Sunny.
Good morning, Wendy.
Hey, everyone. Welcome to Money with Sunny. And today we're going to talk to you about understanding your goals, and financial planning is all about you first understanding your goals. So, Sunny, how important is it that people know where they're at, know where they want to be a year from now, 5 years from now, 10 years from now? How important is that when they first come to meet with you?
First thing I'm going to ask you, what are your financial goals? And I'll want 3. It's just a rule of thumb. There's no reason. It's just 3 is nice. Otherwise, if you give me 10, we got a lot of work to do. But I'll ask you for 3 financial goals, and you have to think in terms of short, medium, and long.
Okay.
So perhaps right now, this particular audience that we're speaking to, it's a transition. How are you going to do a long-term goal when you're in the midst of your finances are probably being uncoupled? You're dividing everything. You're not 100% sure how you're going to land, where you're going to land. No problem. So your goal could just be something like, I just want to figure out my finances today and make sure I'm okay. That's it. Just today, right now. So we could look to work with those. So sometimes a goal that I'll see, especially I call it during transition because I deal with a lot of different types of transitions, but there's divorce, there's career, lots of kind of stuff like that. But your goal could be, I need to get to the other side of this and preserve my asset, meaning I don't want to dip into any savings I've accumulated or any savings I have left after everything's been divided to pay my lawyer or something like that. That is an amazing goal right there. Just preserve what you have. So we would start with that and we would just work on that because we're not going to move forward with retirement planning. You've got a few years of dust to settle yet. So this way we're looking at the different types of savings. But if you're looking to preserve your current RSP balance or your current TFSA balance, or even just not have to sell your house, the first thing is to have liquid money to bail you out of whatever may happen. And this is a savings account. That is step 1 in starting all these other vehicles of RSPs. See, and I can kind of speak to what those are and what the spirit of them is. They are not to be drained in a pinch to pay for whatever you need to pay for, that those pesky things that come up, and I call them attacks on your asset. So you want to limit your risk, protect your asset, and create a little bit of slushy money over here to bail you out when you got to put new brakes on your car. We don't have, $600, $1,000 kicking around usually, but $600, $1,000 expenses are a dime a dozen. They come so fast and quick, and you need that car and you need those brakes. And that's how you're going to start draining the assets if you don't have what I call liquid, which is money you can get your hands on now that isn't a credit card. Yes, there's credit cards and lines of credits. Yes, they can bail you out, But if either you borrow the money or you have the money, if you borrow the money and don't have the money, it means you didn't have the money in the first place. So step one, have some liquid money. Step two is understanding what these registered platforms mean. So like when I talk to people about RSPs, the spirit of an RSP is to provide pension income. That's it. It's not there to be drained on to pay a bill. The purposes of it, with the tax strategies around it, are to save now, pension yourself later. It's your own personal built pension. RESPs, it's your kids' education. I have seen them liquidated in a pinch. So you can, because you're the owner. Your kid is not the owner. Your kid's a minor. You are the owner. You can get your money back. The government's going to claw back their grant and growth, but you can get your money back if you really need it. But the spirit of that is education. And then tax-free savings accounts, they're neat because you can use those for short, medium, and long-term goals. I prefer they have a more medium to long because they tax shelter investment growth. So any money that goes in there, you want to invest it and earn a ton of money in there to get free earnings. If you're putting it in there and it's just sitting in cash or savings and earning nothing, it's just a savings account. It's doing you no favors. Don't bother. Put it in a savings account. Have it ready to go. And then the new FHSAs. These are slick for younger people who are interested in buying a home and need a place to save money in a tax efficient manner to save for a house. That's what that's for. So that's what these things are for. So when you're ready to move forward with your goals, let's look at what are my goals. Do you have that liquid money sitting there in a pinch so that you're not borrowing or liquidating those assets when preserving your assets was so important to you?
So that's number one. Create this slush fund, emergency fund, extra money in a savings account. I mean, I've heard that the number should be 6 months of earnings in that account. Is that right? Or
So I got a bit of a bone to pick with that because so you earn a whole year of income. Can you put 6 months of that away? Sure, if that would be lovely. If you can do that, good for you. But what that ends up doing is being too onerous that I
too
can't.
aggressive. Yeah.
Yeah,
Yeah.
like that.
Right.
And then you don't. So then what happens is we don't. I actually just personally ask people to start with $2,000 because that seems like an income tax return or it's a bit of a bonus or some whatever payments that you got from it's those little extra tidbits of money you can find. But if I'm asking you for 6 months paychecks, it's scary. It's like, well, what's the point? I'll just use my line of credit. So start with more reasonable amounts. Of course, I do like to say the more you own, the more I'd like to see you have in a slush. So if you rent an apartment, you don't own a car and you have no pets, it's just you, have a little bit of money. Okay. But if you own a home, you have pets, you have cars, you have cottages, you have the more assets, the more things that can go wrong, and the more slush money you need to cover more things. Just kind of a stack thing.
Right. So it's unique to each situation. So
But I
it's
start with just like small, $2,000.
right is enough just in case something goes wrong and you need quick cash. Right. All right. Okay, good. And then what else is important? What else should we be thinking about?
So you've determined these goals, right?
Yeah.
So the number one thing I ask people to do when they're looking at their goals is to make sure they're protecting them. So, of course, a lot of people are going to say, well, I want my kids to go to school. Well, we're going to work towards making sure the RESP is going. But I do frankly recommend that you don't put your kids' education in front of your retirement. And I know that's a tough pill for some people. It's just so important. I don't want my kids going through what I went through, or I want them to do better, or whatever. And then it's like, well, your retirement hasn't even started. So I'll have kind of a bit of those, make sure that we're kind of touching on a couple things because retirement creeps up on you. So if retirement is something that you're like, yeah, I want to maintain my lifestyle in retirement, I'm going to get you to do things like just make sure, like, if your employer offers some retirement benefits, that you're participating in those first. I'm not going to ask you to put $200 a month in an RSP. Of course, if you're one that has a pension, that's likely already happening. Awesome. But if you don't know what your work has to offer, or you do and you've chosen not to because you feel a little too broke, it's really an entry point to starting. And I do recommend starting there because an employer could be like, you put 4% of your income in and we'll put in 2% or 4%. We'll match. That's free money. Forget the stock markets. That's that's a 50 to 100% return right there.
Right.
Start
So
there.
have a conversation with your employer about what they offer in the firm. Maybe it's something you have never asked or you don't know about or you've never inquired about. That's a really great idea. I like that idea. So part of goal planning is then kind of knowing where you want to be and where you're heading, and then putting a little slush fund aside, depending on how much assets you have, and that number will depend. And then asking your employer, what benefits they offer, RSPs, RES, not usually, I haven't heard of an RESP benefit from an employer. It's RSPs. Usually they match or they,
DC, defined contribution pension plans. Those are
right?
pensions.
Pension plans, right? So you can make sure that you're taking advantage of that. And then if you're not sure and you're not knowledgeable when it comes to financial planning, meet with someone like Sunny who can, open your eyes to this opportunity, this option, and create awareness about these different options that you do have. I mean, you may have TFSA money just sitting in an account, and it's important that you learn what to do with that and how to take advantage of that. So it's a learning curve that you can work through over the next 6 months, year type thing, and maybe never ends. Yeah. There is one thing that I thought about actually,
Yeah.
and that is your investments may be in your name and your husband's name, and you need to figure out how you're going to change that or how that looks.
So oftentimes, like registered products are in one name. They're not joint. So if there's like an RSP, it's in one person or another because it's under your SIN number.
Mm.
So how that looks when you're dividing those is that's a split where X amount of dollars just gets slid into your name and it becomes that balance becomes your
Right.
RSP. Yeah.
And how about joint investment?
So yeah, joint investments, I don't see it as much in the divorce space because you have to be fairly wealthy to have that, but oftentimes it's just liquidated because when you're changing ownership, they consider that a disposition. So
Mhm.
when it goes from joint to sole, those assets are considered sold. Even if you just slide them into your own name, you're still going to have this tax. So then you can do
Right.
whatever you want with it from there.
Right. So everyone's situation's unique. What are your goals? Where are you at right now? Where do you want to be? How much do you need to learn? What questions do you need to ask? These are all things to consider when it comes to your investments and your money. Sunny, is there anything else that you like to leave people with? Final words, final motivation?
I'm going to say, think about your goals. Just think about it. Dream big. What are they?
Yes, I like it. All right. Well, thanks everyone, and we will see you all again next week.